Picture this: Tuesday morning. You open your brokerage app, and the number on the screen is not the number you put in. You're down thousands of dollars, maybe tens of thousands. And your first instinct, the one every human being on earth gets, is to do something. Sell. Move to cash. Wait until things calm down. I'm going to show you today, with exact numbers, why that instinct is one of the most expensive moves you can make. Because losing money in the market is not the rare exception. It is the repeating tuition fee of building long-term wealth. The investors who come out ahead aren't the ones who avoid losses. They're the ones who respond to them correctly. Most people don't, and it costs them far more than they ever realize. Welcome to the Wealth Metrics, where we turn complexity into clarity with real numbers and zero noise. Today we're walking through exactly what to do when you're sitting on a loss, starting with the math that most financial channels skip entirely. Before anything else, you need to understand one concept. It changes how you think about every loss you'll ever have. And most investors never fully grasp it. Losses and gains are not symmetric. That sounds obvious. But the math behind it is genuinely surprising when you run the actual numbers. You invest $10,000. The market drops 10%. You're at $9,000. Common sense says if the market comes back 10%, you're back to even. That is actually wrong. A 10% gain on $9,000 gives you $9,900. You're still down $100. To fully recover from a 10% loss, you need an 11.1% gain. Annoying, but manageable. Now watch what happens as the losses get deeper. A 10% loss needs an 11-point gain to break even. A 20% loss needs 25%. A 30% loss needs 42.9%. A 40% loss needs 66.7%. And a 50% loss needs a full 100% gain. You have to double what's left just to break even. Read that again. Lose half your money and you need to double the rest just to get back to zero. The loss and the recovery are not mirror images. They exist in completely different mathematical universes. This is called loss asymmetry. We grow up thinking in addition and subtraction. Add 5, subtract 5, you're back to zero. But investing works on multiplication and division. Percentages applied to a shrinking base compound against you in ways that feel genuinely unfair. And this is the foundation of everything else we're covering today. Here's why this matters right now. In April 2025, tariff announcements triggered one of the sharpest sell-offs in recent memory. The S&P 500 hit a maximum drawdown of 18.8% from its peak. To recover from that, an investor needs roughly a 23.2% gain. That climb only happens if you stayed in. So before you ask when this will recover, ask something else first. Are you even positioned to benefit when it does? Every year, a firm called DALBAR publishes the quantitative analysis of investor behavior. 30-plus years of tracking how real investors actually perform versus how the market performs. And for 30-plus years, the conclusion has been the same. The average investor dramatically underperforms the market. Not because of bad picks, because of bad behavior. Here are the 2024 numbers. The S&P 500 returned 25.02%. The average equity fund investor earned 16.44%, a gap of 8.48 percentage points. That was the second largest investor underperformance gap recorded in a decade. Let's make that number real. You start 2024 with $100,000 in a simple S&P 500 index fund. You hold it, you change nothing, you end the year with $125,020. The average investor, making the moves DALBAR tracked, selling during dips, buying after rallies, reacting to headlines, ends 2024 with $112,874. Same starting capital, same market. 12,240 sells less in a single year from behavioral mistakes alone. Now, zoom out 20 years. The average U.S. equity investor returned 9.24% per year. the S&P 500 returned 10.35% per year, a gap of 1.11% annually. Sounds small, right? $100,000 in the S&P 500 untouched for 20 years, 17,503. The same $100,000 for the average investor with all their behavioral decisions. 345 theaters, 614. A gap of $371 to $889 from the same market, over the same period. The market gave both investors an identical opportunity. Behavior silently cut the outcome in half. DALBAR found the exact mechanism. In 2024, investors pulled money out of equity funds in every single quarter of a 25% bull market. The biggest outflows happened in Q3, right before a major rally. Investors were pulling out right as the best gains were coming. This is the most important data point in this entire video. The average equity investor has underperformed the S&P 500 for 15 consecutive years. The market isn't the problem. The response to the market is. Of the 30 best single trading days in the last 30 years, 24 happened during the tech crash, the global financial crisis, and COVID. The best days hide inside the worst periods. You cannot catch them from the sidelines. April 2025 proved it in real time. The S&P 500 surged more than 10% in a single session on April 9th, one of its best single-day performances in history. The market then posted 9 consecutive positive sessions. The recovery was fast, sharp, and completely invisible to anyone who had moved to cash. So, before any tactical move, understand this. Simply staying invested is the single most valuable thing a long-term investor can do during a downturn. It's not the only thing, though. There are moves that can actively improve your position. Let's go through them. The first move in any loss situation is correctly identifying what you're actually looking at. Because there are 2 completely different types of losses, and they require completely different responses. Type 1 is a market loss. Your diversified portfolio, an index fund, a total market ETF, a target date fund, is down because the entire market is down. This is not a problem with your investment. This is the cost of participating. Every long-term investor pays it, repeatedly. Type 2 is a position loss. A single stock or a speculative holding has fallen significantly, potentially because of something specific to that company, not because of what the broader market is doing. For a Type 1 market loss, the data is clear. Stay invested, keep contributing if you can, and don't make dramatic moves. Historically, 10 to 20% corrections recover in about 8 months on average. Smaller dips recover faster, usually around 3 months. For a Type 2 position loss, you need to honestly answer one question before doing anything else. Has anything fundamentally changed about why I originally bought this? That single question drives every decision that follows. The business fundamentals, earnings trajectory, competitive position. Are they still intact? If the thesis is intact, hold or consider adding. If the thesis is broken, that requires a completely different response. We'll cover both. This is the move most retail investors never take advantage of. Depending on your situation, it might be the highest value action you can take right now. The IRS lets you use investment losses to offset investment gains, dollar for dollar. You don't just absorb a loss. You can use it as a tax-saving tool. Here's an exact example. You bought a tech stock for $15,000. It's now worth $9,000, unrealized loss of $6,000. Earlier this year, you sold another holding and realized a $6,000 gain. Without any action, you owe capital gains tax on that $6,000. At 15%, that's $900 out of your pocket. If you sell the losing position and realize the $6,000 loss, the two cancel each other out. Taxable gain, 0. Tax owed, 0. You just saved $900 without any additional economic loss because you were already down on paper anyway. What if your losses are bigger than your gains? The IRS allows you to deduct up to $3,000 of net capital losses directly against your ordinary income each year. At the 22% bracket, that's a $660 reduction in your tax bill from losses alone. Any losses beyond $3,000 carry forward to future years indefinitely. Now the rule you absolutely cannot ignore. The wash sale rule. If you sell a security at a loss and buy the same or a substantially identical security within 30 days, your loss is disallowed. Here's the legal workaround sophisticated investors use. The sector swap. You sell your losing position in SPY and immediately buy IVV or VOO. Both track the same S&P 500 index, but are issued by different companies. Under current IRS rules, they're not substantially identical. You stay fully invested, capture the tax loss, and miss 0 days in the market. The same logic applies to individual stocks. Sell a losing tech stock and immediately rotate into a broad technology ETF. You maintain sector exposure without triggering the wash sale rule. To recap, sell the loser, immediately buy a similar but not identical ETF. Losses offset gains dollar for dollar. Up to $3,000 deducted against ordinary income annually. Unused losses carry forward indefinitely. Do not rebuy the same security within 30 days. And this only works in taxable brokerage accounts, not IRAs or 401ks. One more thing, even in a year where you have no capital gains to offset, the $3,000 ordinary income deduction is still real money in your pocket. And every loss carried forward is a future tax asset most investors never think about. This next move looks obvious on paper, but most investors emotionally cannot bring themselves to execute it. When prices fall, you get more shares per dollar, more ownership of the same companies, Apple, Microsoft, Nvidia, Amazon, at a lower price. That's not a problem. That's the opportunity. Here's the math. You invest $500 per month in an S&P 500 ETF. Month 1, the price is $500. You buy exactly 1.0 share. Month 2, market drops 15%. Price is $425. You buy 1.18 shares for the same $500. Month 3, another 10% down. Price is $382. You buy 1.31 shares. Month 4, market recovers to $500. You now own 3.49 shares worth $1,745. You invested $2,500 across 4 months. Compare that to an investor who paused contributions during the dip and only invested in months 1 and 4. They own 2.0 shares worth $1,000 for $1,000 invested. Dollar cost averaging through the dip produced a 74% better outcome on the same capital. Not a prediction. Just math. The mindset shift. For a long-term investor still building wealth, a portfolio that's down is not a portfolio to avoid. It's a sale on the same future you were already buying. Every dollar you add at a lower price lowers your average cost permanently and accelerates your recovery once the market turns. One caveat: this applies to diversified broad market investments. Averaging down into a single company with a broken business model is not a strategy. Know what you own before you add to it. We've covered the math. Now let's talk about why none of it matters if you can't control what happens between your ears when a drawdown gets painful. Psychologists Daniel Kahneman and Amos Tversky documented something called loss aversion. The emotional pain of losing $1,000 is approximately twice as powerful as the pleasure of gaining $1,000. Losing hurts more than winning feels good, by a factor of 2. This isn't a character flaw. This is biology. For most of human history, losing resources was a survival threat. Your brain evolved to avoid losses aggressively. Financial markets are a few hundred years old. Your brain is not updated for them, and the financial media understands this completely. Every markets in turmoil headline, every analyst predicting catastrophe, every red portfolio screenshot on social media, these are engineered to provoke a reaction. That reaction, selling, generates trading volume for someone else. Your panic is literally someone else's revenue. When you feel the urge to make a dramatic portfolio move during a downturn, run through these 3 questions first. Question 1. Has my time horizon changed? If you're 35 and investing for retirement at 65, a 20% drawdown in 2025 is statistically irrelevant to your long-term outcome. If you need the money in 18 months, that's a legitimate concern. But the solution was proper risk allocation before the drawdown, not panic selling during it. Question 2. Has my investment thesis changed? For an index fund, the thesis is simple. The economy will be larger and more productive in the future than it is today. A tariff shock, a rate scare, a geopolitical event, none of these permanently impair that thesis. For individual stocks, honestly assess whether the reasons you originally bought still hold. Question 3. Am I about to make a permanent decision in response to a temporary event? Corrections are temporary. Every single one in market history has ended. Selling locks in a permanent outcome. Historical data shows the average market has recovered from even recession-level declines within 1 to 2 years. Investors who sold during those declines locked in permanent losses and missed recoveries worth multiples of what they lost. 2 more practical moves before we get to your specific action plan. First, rebalancing. If your target was 80% stocks and 20% bonds or cash, and equities have dropped significantly, your portfolio may have drifted to 70-30 or even 65-35. Rebalancing back to 80-20 means mechanically selling what held its value and buying more of what declined. That feels uncomfortable. It shouldn't. Rebalancing forces you to buy more equities when they're cheaper without requiring any market timing or prediction. Most professionals recommend rebalancing once or twice a year, or whenever allocation drifts more than 5 percentage points from target. Second, position sizing. If a correction hurt you badly enough that you're questioning your whole financial plan, the problem probably isn't the correction. It's how concentrated your portfolio was going into it. A diversified broad market investor during the April 2025 drawdown was down roughly 18.8%. Painful but recoverable. An investor with 50% concentrated in a single volatile stock or sector may have been down 40%, 50%, or more. At those levels, the recovery math becomes brutal. Here's the individual stock data every concentrated investor needs to hear. A study covering over 6,500 stocks from 1985 to 2024 found the median individual stock drawdown was 85%, and 54% of those stocks never recovered their previous peak. Not in years, not in decades, never. That's the mathematical case for owning the whole market through index funds. You get the losers? Yes. But you automatically own every winner that drives the index to new highs, without having to identify them in advance. Let's bring it all together. Here is your action plan, built specifically around the situation you are in right now. Situation A. Long-term investor in diversified index funds, haven't sold anything. This is the strongest position to be in. Action plan. Do not sell. Review the 20-year compounding numbers and let them reset your instinct. If you have cash available, deploy it in tranches over the next 1 to 3 months and dollar cost average at current prices. Check your allocation. Rebalance if it has drifted. If you have realized gains elsewhere this year, run the tax loss harvest. Then stop checking your portfolio every morning. Situation B. You're holding a losing individual stock. First question before any action. Is the original investment thesis still intact? The business fundamentals, earnings trajectory, competitive position, all still what you believed when you bought? If yes, hold. The math of holding a fundamentally sound business through a market correction is in your favor. Time is on your side. If the thesis is broken, earnings have deteriorated materially, competitive dynamics have shifted permanently, consider cutting the position. In a taxable account, execute the tax loss harvest and rotate into diversified exposure. Do not average down into a broken thesis. That's not buying a dip. That's compounding a mistake with more capital. Situation C. You already sold. You're sitting in cash watching the market. Staying in cash is not a neutral decision. It has a real cost. The opportunity cost of every day the market moves without you. And based on 30 years of DALBAR data, investors in this situation consistently underestimate that cost by a significant margin. Action plan. Stop trying to time the perfect re-entry. It doesn't exist. The market does not send a notification when the bottom is confirmed. Divide your available cash into equal portions and invest one portion per week or bi-weekly over the next 2 to 3 months. This removes the emotional weight of picking a single perfect moment, except that you might re-enter at prices above where you sold. That feels bad. But staying in cash while the market recovers is mathematically worse for your long-term outcome. Situation D. You're within 10 years of retirement, and this drawdown has materially affected your timeline. This is the one situation where just hold on isn't the complete answer. Sequence of returns risk is real. A large loss right before or after retirement hits differently. When you're drawing down the portfolio instead of contributing to it, a sustained loss does more damage than it would to a 35-year-old with 30 years ahead of them. Don't make wholesale panic changes, but honestly, review whether your current stock-to-bond allocation still matches your actual time horizon and income needs. A gradual, incremental shift toward slightly more conservative positioning, done over months, not days, can reduce that risk without costing you the full upside of a market recovery. This is also the one scenario where talking to a fee-only fiduciary financial advisor is genuinely worth the cost. Not a commission-based broker. A fiduciary who is legally required to act in your interest. Let me make this real with a concrete example. Meet David. 41 years old, $120,000 portfolio split between a total market index fund and 3 individual tech stocks. The correction has hit him, and he's down roughly 19%, about $22,800 in paper losses. His index fund, about $80,000 of his portfolio, is down with the market. His 3 tech stocks, the remaining $40,000, are down between 15% and 35% each. One of them, an AI software company, has seen 2 consecutive quarters of earnings deterioration. That one is off 35%. Step 1. Identify the loss types. The index fund is a market loss. 2 of the tech stocks are down, but fundamentals are intact. Also, market losses. The AI software stock? Thesis has changed. Step 2. Harvest the broken position. David sells the AI software stock, realizing an $8,000 loss. He immediately buys a diversified tech ETF. Tax loss captured. Fully invested. 0 days missed. Step 3. Keep contributing. David sets up $500 per month into his index fund for the next 6 months, buying more shares at prices roughly 19% cheaper than his previous average cost. Step 4. Document the thesis. David writes down exactly why he holds his 2 remaining tech stocks. Both theses are valid. He holds, and he stops checking the app every morning. 12 months later, the market has recovered. David's index fund is back above its pre-correction high. His 2 intact tech stocks recovered with the sector. The AI software position he cut is still well below its previous high, and significantly underperformed through the recovery. His tax loss harvest saved him $1,200 in taxes. His continued contributions through the dip improved his cost basis for years to come. Framework instead of feelings. That's the entire difference. One thing before we close. The S&P 500 has survived 2 world wars, the Great Depression, double-digit inflation, the dot-com collapse, the global financial crisis, and a global pandemic. Every single time, over a sufficient time horizon, it recovered and went on to new highs. Every single time. In the fourth quarter of 2025, S&P 500 companies reported revenue and profit growth of nearly 13% year over year. The underlying businesses in the index are growing. Short-term prices are driven by fear and sentiment. Long-term prices are anchored to earnings. That's not theory. That's 100 years of market history. The math is simple even when the emotions aren't. A 20% loss needs a 25% gain. The S&P 500 has averaged roughly 10% annually over long periods. A patient, invested investor should, based on historical averages, recover from a 20% correction and reach new highs within 2 to 3 years, especially if they kept contributing through the dip. The investors who don't recover are the ones who turned a temporary paper loss into a permanent real one by selling. Don't be that investor. Here's the full framework, start to finish. 1. Know your asymmetry. A 20% loss needs a 25% gain. A 50% loss needs 100%. Losses are not symmetric with gains. Most investors never fully internalize this until they're already sitting in cash wondering what happened. 2. Don't let behavior compound the damage. The market didn't cost the average investor 12,240 sidlers in 2024. They cost themselves that money through behavioral decisions during a 25% bull market. 3. Tax loss harvest, if it applies. Sell the loser. Rotate immediately into a similar but not identical position. Capture the tax benefit. Stay invested. 4. Dollar cost average if you have capital to deploy. More shares at lower prices is a mathematical advantage that accelerates recovery and permanently lowers your average cost basis. 5. Rebalance mechanically. Let the process make the decision. If your allocation has drifted, rebalancing forces you to buy more equities at lower prices without requiring any market prediction. 6. Know your situation and execute accordingly. Long-term index investor, stay in, contribute, harvest. Individual stockholder, assess the thesis before you touch anything. Already in cash, structured re-entry over 2 to 3 months. Near retirement, review allocation and talk to a professional. The market will have more corrections. It always has. It always will. The investors who build wealth aren't the ones who saw them coming. They're the ones who responded with a framework instead of feelings. You have that framework now. And you have the exact math to back every decision it leads you to. Quick reminder, everything in this video is for educational purposes only. Not financial advice, not tax advice. Please consult a qualified professional for guidance specific to your situation. If this gave you clarity, hit like. It genuinely helps. The wealth metrics reach more people who need this kind of perspective when markets get rough. If you want more content like this, subscribe. Every video on this channel is built around the same thing. Real numbers, real math, no noise. Drop your biggest question about managing a down portfolio in the comments. I read every one, and your questions directly shape what comes next. The math is on your side. Use it.